In this video, traders, we're going to look at bull market bad habits. Stay tuned. Hey guys, warm welcome to you. All right, so I just missed out on the whole late 90s kind of boom where we had loads of tech stocks that was ripping. I've spoken to guys who are involved in it. It was just like literally buying the strongest thing. It was ripping up. I started in 2001, just after the bubble burst. Yes, I know, genius timing. Who was getting involved in the market then? Me. 2001, 2002, 3, etc. But the point is, guys, is that we're in a bull market now, and yes, it's not quite as aggressive perhaps as we had in the tech boom and the internet boom and all this kind of stuff that was going on in the late 90s. But you know, there's the bull markets still have these kind of cycles where, you know, they start to get some exuberance, they start to get going, and ultimately, you know, we may stay in a bull market for another decade. You know, we may be in a kind of new revolution of technology, and I think that's a valid argument to some respects. We may go into a multi-year bear market. You know, we don't know what's around the corner. And so as traders, you know, we have to be careful that we don't have these bad habits in bull markets, because otherwise all that happens is we make loads of money when the markets are going great, which is fine. We should take advantage of the bull market, but ultimately it's still kind of maybe leaving a little bit on the table so that you have longevity in the market. There's too many stories from guys who have made millions on paper pretty much in the kind of tech boom, the NASDAQ boom, late 90s, lost it all, and kind of that was their foray into the market, and now they're just, you know, not involved in it much, and they've kind of really been burnt by and all that kind of stuff. So, you know, it's something to consider. What you want is to make as much as you can in the bull market and still have, you know, a skill set to use if you're in a bear market, a skill set to use if we're kind of mutual range bound conditions, and maybe take a break when it's gone quiet. So, you know, there's this adaptation and different skill sets. So some of the bad habits, let's get to the kind of point of the video, guys, the bad habits that we've got to watch out for in bull markets. Now, I'm not saying we shouldn't maximize the opportunity. I'm not saying we shouldn't use it to our advantage. What I am saying is we should just be mindful that we don't know when the good runs are going to end in bull markets. We just know that while it's there, we should use it to our full advantage, but we have to be aware of these things. Number one is holding onto a stock and getting away with it. Super common thing in bull market. You buy a stock, goes down, you just hold it because stocks just keep going up, and while a bull market is in rampant full mode, that's true, and you get away with it, and you get out of jail free, get out of jail free, get out of jail free. Pretty much most stocks, if you hold on to them long enough, unless your timing's well off, on a kind of big basis, you're going to get away with it. You know, stocks are going to pull back and they're going to go push on, because that's the nature of bull market. It's just persistent strength, time after time after time. Number two, not fine tuning your entry. You can get lazy in a bull market. Market's ramping on. You're like, well, I'll just buy that stock, and you just kind of pick a stock, you buy it, and then next day it goes up, next day it goes up. It's like, fine, you know, I got a good trade. Now, you know, when we're fine tuning means kind of waiting for that pullback, or waiting for a pullback to moving average, or a flag, or consolidation, or a pause, or something to give you a bit more of a sweet spot of an entry. And we can become a little bit lazy with it because we get rewarded with it. We buy it when it's at highs and it keeps going to highs. Now, that works in a bull market. I'm not saying don't do that per se, but what I'm saying is just be mindful that in less aggressive conditions that will fail you, because the more cyclical nature and the rotational nature of the market will mean that that's a losing strategy. So if you're going to do that, be aware, okay, you know, it's fine, works in a bull market, but better to kind of, you know, fine tune things and add a little bit more finesse to your entry. Number three is adding on dips. This is really when you're adding into a trade that's going against you. I think this is a super bad habit to get into. I know that you get rewarded for it in a bull market, and you get rewarded quite nicely actually, because you add to your position, you get a really big position just when it starts to go back to highs, and you get rewarded financially very well for it. The danger is when we're not in this persistent taking out of highs, that can really take you out. So just be careful of adding on dips when it's adding to your position. Number four, doing little or no research. So it can be easy to kind of fall into the trap of going, you know what, I'm just going to buy the stock that's up the most, or I'm going to buy the stock that's people talking about the most. And there's a certain degree of acceptability in that, because if you're trading momentum, fine, you know, trade the momentum stocks, but not at the expense of doing your own research in terms of you know, technical analysis on the chart. If you want to do some fundamentals, who's short in the trade, when's the earnings coming up, what does it look like, you know. I'm not saying dig into the actual earnings, you know, reports or anything like that, or the details and the financial details, but your screening stuff, still doing your screening, still doing your technical analysis, still doing your top-down analysis, that should still have it in a bull market, even when something's being brought to your attention by just the media, or by some sort of tip sheet, or by some sort of newsletter, or by just a hot list or something you're using in your platform. And number 5 is you not using any proper risk control. Similar, I guess, to adding on dips, but bull markets let you be a little bit loose with your risk, because you get away with stuff. As long as you're long, you're not short, you get away with it, because the tide rises and lifts everything up, and you kind of do this position size, you're trading this, not really using a stop, you get away with it, but it'll come back to bite you in different market conditions. Number 6, believing everything always goes up. Of course, we get conditioned to thinking stocks are going to go up, stocks are going to go up, stocks are going to go up, and buying the hot stocks, they're going up, making money, you're putting good money in your account, but ultimately it's not always that way. When we start to go into a stagnation, or if we start to go into stagnation, we've got to go into a bear market, the game changes. It's finding the weak stocks if you're trading equities, of course. It's pressing into lows, it's reversing the decision making, and understanding the pullbacks in the bull market are quite shallow. The pullbacks in bear market have different characteristics. They're real snapbacks and then push lower. So it's a different way of trading and different style of trading. So anyway, the point is, guys, while there's a bull market, if you're trading on the long side, great, extract as much profit as you can from the market, use it to your advantage by all means, but just be aware who knows if they will, and when condition, well, they will at some point, but who knows how long they'll get out of it. When they change, being able to adapt and adjust and not giving all your gains back just because the market's not as rampant as it was when you were making all the gains. Anyway, guys, take care. I'll see you in the next one. Bye-bye.